Have you ever been at the gas station just watching those numbers spin higher and higher, and you just feel your stomach drop? Yeah, we've all been there. But what if I told you that that exact feeling, that sinking mood, multiplied by millions of us, could actually be the thing that steers the entire US economy? It sounds wild, but let's get into it.
So let me ask you this directly. How much does your mood, your gut feeling about your own finances, really matter to a multi-trillion-dollar economy? You'd probably think, not much, right? Well, the answer is a whole lot more than you think. And our whole story really kicks off with this one number, $3.63. Now, this isn't just some price on a sign. It represents a more than 21% jump in the average price of gasoline. That's a sudden jolt that millions of Americans started feeling, like a gut punch right in their wallets in early March.
And that price spike is our first big idea here, the shock at the pump. This is what economists call an energy shock. It's sudden, it's disruptive, and it's a perfect example of how massive global events can show up in your day-to-day life. I mean, think about how crazy this is. Escalating tensions in the Middle East, something happening thousands of miles away, are the main reason for this price spike. All that uncertainty in the global energy markets, it flows all the way down the pipe until it ends up right here at your corner gas station. So when prices at the pump shoot up, something else almost always goes down. And that brings us to our next part. America's mood turns sour. Because we can actually measure this collective feeling, this national mood. The way we do that is with something called the Consumer Sentiment Index. The best way to think about it is like a report card for the economy, but it's graded by all of us, the consumers. It's a number that tells us how optimistic or, pessimistic people are feeling about their money and what's coming next. And in early March, that grade came in at 55.5. Now, on its own, a number like that doesn't mean much, right? To really get what it's telling us, you gotta have some context.
And here's that context. Just a month before, in February, the index was sitting at 56.6. After that gas price spike, it dropped to 55.5. Now, that might not look like a huge fall, but in economic terms, that's a clear signal. It tells us that people's confidence is starting to wear thin.
And here's the really crucial part. This isn't just one type of person feeling the squeeze. The data from the survey is super clear. This drop in confidence is happening everywhere. It doesn't matter how old you are, how much money you make, or which political party you side with. Everyone is feeling more uncertain.
Okay, so confidence is down. Seems pretty simple, right? People are worried. But hold on, because this is where the story takes a really interesting twist. There's another key piece of data that's telling a completely different and, frankly, surprisingly stable story. Check this out. Even though people are worried about right now, their expectations for inflation way down the road are holding pretty steady. They think inflation will be around 3.4% over the next year, but over 5 years, they actually expect it to be a little lower at 3.2%. What this tells us is that deep down, people still seem to believe the Federal Reserve can get prices under control in the long run. So we've got this weird mix, right? Short-term anxiety, but long-term faith. This brings us to the big so what question. Why does any of this matter? Well, it's because this balance of feelings is, in a lot of ways, the engine that drives the entire economy.
I mean, this chart says it all. Consumer spending. That's me and you buying groceries, cars, coffee, you name it. It makes up roughly 2/3 of all the economic activity in the US. That's not just a big slice of the pie, it practically is the entire pie. And that creates a really simple but incredibly powerful chain reaction. When we feel less confident, we get more cautious. We put off buying that new car, we eat out a little less, we just hold on to our cash a bit tighter. And when millions and millions of us do that all at once, the whole economy starts to slow down. This whole situation creates an unbelievably tricky puzzle for the folks at the Federal Reserve. It basically forces them to fight what you could call a two-front war. It's a classic high-stakes dilemma. Here's the trap they're in. On one hand, rising gas prices are fueling inflation, which tells the Fed they need to keep fighting it, probably by making it more expensive to borrow money. The risk? You could slow down the economy too much. But on the other hand, falling consumer confidence points to a weakening economy, which tells them they need to support growth. The risk there? You could let inflation get even worse. They're walking on a policy tightrope. So where does all this leave us? Well, the huge question that everyone, especially on Wall Street, is trying to answer right now is this. Is this just a temporary blip from that energy shock? Or is this the start of a real, more serious slowdown? To figure that out, here are the three main signals to watch. First, how much are energy prices going to keep driving everything else up? Second, is the consumer, who's been surprisingly resilient, finally starting to crack? And third, how in the world are central banks going to navigate this incredibly complex path? The answers to those questions are going to tell us what happens next.
Which leaves us with one last really powerful question to chew on. In an economy that is so dominated by our spending, have our collective feelings, our optimism, our pessimism, our mood at the gas pump, become the single most powerful force shaping our entire economic future? It's something to think about. Thanks for tuning into this explainer.